Hello guys, glad to have you on board again. Today, slowly but steadily recovering my voice and getting over this very rough couple of days. But yeah, that's the usual life stuff. Like getting sick is part of life. I don't make it overcomplicated or anyway. So I just don't want to go too rough as I get back on my feet. So I'm gonna make a real quick one today, probably 15 minutes, no more, no less. Just as this will be quick, I can hardly cover the correction for the MCQ test or stuff like that, so I'll just have to delay them probably till next week, obviously. So we missed the shot on the beginners podcast on Tuesday. Today is supposed to be the intermediate podcast and stuff like that, so I think this week I'm going to cancel every level specific kind of podcast. I'm just going to do some kind of a recap of the latest 2 days today, and tomorrow we'll just make a perspective for next week or stuff like, or something like that. I still haven't yet figured it out. Depends on which healthy state I'll be tomorrow. If I can really be better, eventually I'll do the MCQ test tomorrow, but I sincerely doubt that. Anyway, so the stand we're currently in, and even if I was sick over the course of the latest 2 days, that doesn't mean I haven't been trading, neither looking at the market or whatever, right? I'm still at work. It's just I was into no communication mode, or just typing in through Discord. So what I've done yesterday is profit taking on the GBP exposition. So GBP GPY and GBP USD has been reduced yesterday. I never expected we would make new highs over the course of the day, so really showing signs of strength. So anyway, I wanted to profit take in this area. That was my target area, as you can see. Alright, so this was a targeted area. I told you when we get into this, I want to profit take. So we got just an inch away from my profit taking when we were, where was that? God damn it. Yeah, when we were in here, we just got inch. Right, like this this alert was set in here, right, like right below the maximum prices. Remember that this is the area in which I had a mandatory profit taking, and we just got there inch away from my entry, from my target price for to trigger the alert. So obviously no profit taking. I saw the pullback, so I decided to profit take right in the average price, which was 1.27, something like that. So I took my 1/3 profit taking in here on GBP USD. I took the same amount. No, I took 1/4 of GBP USD, and I took 2/3 out of GBP GPY. Where the hell? Simply because I think GPY is going to be stronger right now, so I would have wanted to take a bigger share of GBP GPY. Right, simple as that. So GBP GPY, we're reaching out resistance in here, which is the which is the higher the volatility boundaries. So let me be clear in here. I know you might see me using way more Bollinger Bands than previously for simple reasons. I'm adding patterns based on volatility within the indicators. So I'm working a lot more with the Bollinger Bands recently, just seeking for patterns. So don't mind me. That doesn't mean I'm nearly changing anything regarding the trend channels. All right? Most of the time I've got both of them on the chart. It's just all right, don't worry, I'm not letting it go with the trend channels. And if you think, all right, Bollinger Bands are better than trend channels, like I told you, these are false friends. The trend channels, whether you like them or not, are the best way for you to contextualize the market. And if you do trade just out of volatility without contextualizing what you're dealing with, you're going to have strong problems. So don't go down this road, all right? Remember that trend channels is the basis. You really need to master them before going anywhere close to volatility trades, all right? But the problem is right now volatility is also the biggest deal because we're seeking for volatility as some markets try to make it shrinking, like the VIX, who's been making its monthly expiration to lows. That's incredible. I never thought we would be able to do such thing. I mean, just 4 days later, 4 days earlier, we were in here with a bullish trending VIX and then magic happens. We've got $60 billion QE per month. The Fed doesn't want to call that QE, but I'm sorry, you're buying bonds for money, which means QE, all right? So we've got a new QE showing out of nowhere. There was no announcement. Generally, when there is a monetary policy shift, just something important like that, it's a fucking QE. I mean, it's not like we spend some money and all right. No, it was a radical change made out of any FOMC meeting. So it has been unplanned, unexpected. It's like a last minute move at some point, and it really should be worrying a lot of investors, because yes, on one end you still have the beautiful magical thing of Donald Trump saying the economy is strong, whatever, and on the other end you've got professionals saying, oh my god, we really need to support this shit and we have to do it now, not even waiting for the next meeting of the FOMC members. So that's really concerning me. The divergences keep going wider, right? We're spreading out visions. You've got real positive visions and real negative visions, and like I said, this can't lead anywhere else to volatility. And what do we see instead? Contracting volatility. So I see the same old stupid guys making their bets that anyhow and anyway everything will be fine. And these are the guys that generally tend to create a financial crisis. So I see them at work just like I've seen those guys. No, I wasn't trading back in those days, but I've been studying 2008 crashes as well as the 2000, and still the same old fucking guys at work. And that's incredible that these guys are not yet regulated. Like, we let them do whatever the fuck they want because, I mean, that's what we would like to see. A low volatility, confident market in which investors are getting in the money, are spending their money to invest and whatever. And we've got totally the opposite right now. Ask an investor what he thinks. I mean, the investor's confidence is as low as it could be. They all got into buying bonds, and now bonds are shrinking, and we might be on the verge for another move. Like, first, the smart money got out of the riskier assets, like the apples, the stuff like that, because they were overextended and prices weren't nearly meaning any fucking thing. So they got the hell out of here. That doesn't mean they sold everything. It's just that they sold part of their positions in these companies. So what did they do with the cash? They bought a little bit of gold and bought a little bit of bonds. Right? They've been shifting to less riskier assets, and now they might be shifting away from bonds, getting into another sector. Now the question is, what is this sector? I tend to believe this sector is the value stocks. I think they're going to get into value stocks, and I think they're going to go into even more precious metals. So I think gold and value stocks is probably the next big move for smart money managers, and that can't be bullish for stocks, and especially that can't be bullish for stocks that have been bought with credit, right? Because that means less incentive credit into very expensive assets which require high leveraging to get there. Like buying an apple right now takes you $234. Right? Though that means if you don't have those dollars, you need to lend money to buy that shit. And that's a huge concern, because obviously those very expensive stocks are hardly going to be asked and demanded, simply because less easy access to credit into very dangerous valuations means they will be left behind. And they will instead get into buy stocks that cost not a lot, doesn't require much credit, but still can provide value. And if you get to this point, you understand what the next rotation probably is. I've been waiting for quite some time for this rotation to show up. I think it is about to show up. As for what you can see, you've got this, all right? Even if the Fed tried everything they can to reverse that, they timed in the QE right in here. That's the reason why they triggered the QE earlier than expected without giving any signs of it before. They saw this thing going out of control. This simply means the guys are asking out. They don't want to buy more bonds. They're most likely selling them. And as they do this, the Fed doesn't want that to happen, so they trigger QE to force them into bonds. But as you can see, it's not working. If it was working, we would have reversed instantly. We don't, and something goes wrong. I think the Fed is losing control over bond investors, and if they start to lose control, it means there's no longer confidence. And if there's no longer confidence, that's still a little bit too early. We're just 5 days in, but if this thing happens, is exactly what happened out of 2008 crashes. All right, all of those things, 2001, 2008, that's when we reversed the yield curve that the shit started to hit the fan. We might have a little bit of hesitation in the nearby area, so if you think that's an instant thing to do right now, like switching to crazy fucking bearishness or whatever, that's not the case. All right, it's just something in here has changed, and I think it's certainly not about time to change my mind on those plans. I'm just waiting. All right, remember that I'm doing weekly portfolio management right now, so yeah, I'm patient. I'm just waiting for the next move to show up. I want to see breaking supports on the same old Apple, Microsoft, and stuff like that. Remember that this thing can only be exploited when stocks, and especially growth stocks, goes down in the same time. So I need the confirmation that the smart money is rotating. I know my job, so I can tell you they probably are, but I need confirmations. All right? So in the meantime, I personally stick to my current plan, which is trying to sell Wall Street smartly at volatility boundaries, rapidly securing the trades, and then letting it go. All right? And then as long as I get stopped out with no loss, I try again and try again and try again until I get one to work with. All right? Normally, stock markets indices should go down, even though they shouldn't be crashing instantly. All right, because remember that rotation gets the favored value stocks, but those value stocks weights like very tiny portions into the very broad indices and stuff like that. All right, so they will support indices and broad-based indices like the SPX. So I tend to believe SPX might not be the wisest choice for you to get invested in for bearishness, because it might just go in these areas, and I think they might go down these areas when the shit will really hit the fan, like the Apples and the Microsoft surging to the downside, like losing 5 to 10%, and retail investors starts to panic because they're mostly invested in those assets. When they lose 10%, these guys will come out and cry out for help. All right, so we'll see, but that's what I'm doing right now. Right, I'm still looking at selling those stocks. I'll look really closely at GE in the forthcoming days to see if I get to buy this a little bit more, take some more money in there, or eventually gather some other value stocks to add in the portfolio as well. But that's the next big swing rotation I'm looking forward for right now. Reinforcing my exposition to value stocks, eventually waiting for confirmation, validations that the growth stocks are heading to the downside, and normally that should push our equities indices to the downside, and especially the sectorial ones. All right, so what I'm going to be trading is most likely sectorial analysis, like these guys. All right. Damn it. Yes. All right, so what I'm going to mostly get to trade is this. I'm going to look for the weakest ones, and let's be honest, to me, it's consumer staples. They've been making a weekly bearish engulf, monthly bearish engulfing. So I think these ones are really, really the weakest. All right, probably materials will hold on this area. I think technology is under grave danger, great danger. So it's more likely selling XLK, XLP. I think financial might be not that bad. I think consumer discretionary is under problems. I think there is huge concerns in here, and healthcare is still under huge troubles as well. So to me, it's like that. All right, XLV, XLI, XLY, sorry, XLP, and XLK. I'm gonna try selling those sectors more than the others. All right, it's pure and simply this. All right. I'm going to look for value, which is probably I'm going to try catching stocks that are in the utility sector, but I'm going to buy them on supportive area, right? Though I tend to believe prior to anything, I think everyone will start to head to the downside, get to value trades, which means when the value stocks will get to supportive area, I think that's going to be a good buy, right? So like waiting for utilities to get there. that's not a huge drop, right? Like when you go there, it's like -10% on utilities, in which I think discretionaries can lose 20, 18. I think healthcare as well. Not that big of a deal in here, retracing to the major support, but where I think consumer staples can lose 20. All right, like all those things were tracing to their previous supports, and this is where I think the huge problem could be, like an early technology crash. But we'll see this one. All right, this one is it's the most dangerous one to deal with. Like I said, huge potential, but we can also make a 5 to 6% upward move, just trying to bring in some DOMs and stuff like that. All right, always the biggest gains doesn't come up without risk. All right, I'm gonna stop in here, guys. See you tomorrow.